We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Peter Goodburn, founding partner of Wave International. Peter, thanks for joining me again today. How are you?
Great. Thanks. Thanks for inviting me, Tom. It's been a while, so I'm really looking forward to this.
Me too. It has been a little while, but it's always great to catch up. We had a good chat before we hit record here this morning. I guess this morning for me, this afternoon for you. But, Peter, the last time we spoke, you explained to us your view on the commodity supercycle that began from the Great Depression lows. So with that as a backdrop, can you explain to our listeners a bit more about your commodity supercycle theory and how you see it playing out?
Yeah, that's good. Well, I think that when we talk about a commodity supercycle, and a lot of people are talking about it again, it's a very topical subject. Generally speaking, how do we define a commodity supercycle? Well, I think we have to look at it from a historical perspective. Probably, if we take very long-term data, and we might look at, let's take, maybe I could, is it possible I could show my screen at the moment?
Yeah, of course.
Maybe I just get ready with a very long-term chart on the CRB index, for example. We're going to have to go back a bit in time to do that. What I'm going to show you is, this is a very long-term commodity cycle. This is actually the Bloomberg Commodity Index, which is extrapolated originally from data from Richard Mogi, who was a past chairman of the Foundation for the Study of Cycles. And this data we can see going back to the Great Depression lows. Now you can see there's a big correction down into 1932, 1933. So this is very similar to what happened during the stock market sell-off in Wall Street back then. And technically, this is a commodity supercycle. And we're not really talking about a commodity supercycle in more latter day periods like now or post financial crisis or even post pandemic. Really, we've got to look at decades long of commodity supercycle. And this one certainly fulfills that criteria, going back to the Great Depression. It's a very typical Elliott Wave 5-wave pattern. Now, for anybody watching or listening in, Elliott Wave is a model of price progression. We tend to sort of define it where progress in any one direction, and it's probably easier for everybody to conceptualize this in an uptrend. It evolves generally into 5 price swings or 5 waves. And once that 5-wave pattern has been identified as completed, there has to be a balancing 3-wave correction in the opposite direction. So here we have a typical 5-wave advance from 1933's low, 1, 2. So this moves into the 1960s. 3 gets launched up into the late 70s, early 80s. So that was gold's initial all-time high back then as well. Wave 4. This brings us back into the late 90s when silver was bottoming, gold 194. And then we see this big sweep to the upside, which is pre-financial crisis. It goes into the highs in 2008 at 233 on this index. It's the same for the Thomson Reuters CRB index as well, or any of the old cash indices that we looked at the time. There's various different commodity indices we can look at. But this is the defining nature of the commodity supercycle. So if you're really reading about commodity supercycles in news and media today, this is not really what it is. We're in actually, from the larger perspective, looking from a great height, looking down at these long-term patterns, we're looking at actually a counter trend phase, which can then again last a decade or two, and maybe 3 decades in its own concept, because we're talking about the peak in 2008. We've already seen the beginning of this correction down with a big drop back here down to 60.50. So we've already gone from 233 to 60.50, huge percentage drop into the pandemic low. And the pandemic low was a lower low for oil prices. If you remember, oil prices collapsed from about 140 down to, well, we got down to $650 on WTI on that forward contract. And if anybody remembers trading it at the time, the front month even went down to -40. So that was a bit of an extraordinary situation. But that was only the first phase of a three price swing event, which is going to last decades. And the following upswing from the pandemic low in things like oil, or you can look at copper prices from the financial crisis lows in October 2008. They got a slightly different rhythm, but in effect, the same type of sequencing. They're rallying higher in a secondary phase, which is part of the regression period of the long-term super cycle ending in 2008. And this secondary phase, where prices rise, I termed about 10 or 12 years ago as the inflation pop cycle. Mm-hmm. So it's not a commodity super cycle per se, by definition. This is very much misunderstood. It's basically an inflation pop cycle, because we're going to get bouts of inflation coming back in. Now, why do we know that? Well, we could also take a check on long-term interest rates, because long-term interest rates topped out in 1981. That was the last big inflationary cycle peak. And we've been in a deflationary cycle for 35 years or more since then. And actually, there's a 60-year cycle on interest rates. It should have bottomed basically around 2001, but it's been extended right the way through to basically pandemic lows, so in 2020, due to intervention by central banks. And because of the financial crisis, that sell-off, basically the central banks came in with quantitative easing, cut interest rates and so on, and they perpetuated that. Rather than them neutralizing interest rates whilst the stock market and commodity markets were rising post-financial crisis, they chose to keep the taps running. And that's produced, this huge imbalance in printing money to such an extent that assets are still basically trending higher. And we've still got a lot of upside to come in the next 2 to 3 years on commodities overall. It depends on what we're looking at, but overall, we can see big gains in things like oil in this secondary phase. Oil prices should actually even break above new record highs. Things like copper will probably make new record highs as well. So in the next 2 to 3 years, you'll probably get you'll probably see headline news that copper is in a super cycle bull market because it's broken into new record highs. It's a bit of a bear trap, to be honest. This particular index, it starts moving up in the inflation pop cycle, and it's itself composed in a fractal three price swing event, and it's rather sort of geared to oil, where it goes up into this April 22 high. It's currently pulling back, so oil prices are currently under pressure, pulling back in the second phase, and that will continue this year. And then once we finish this year, a decline in things like oil and copper prices, well, then in 2020, 2025, 2026, and 2027, these 3 years, we're going to get basically this big push up into new records. This one, I don't think will quite make it. I think it will get close to the old peak, which is the super cycle peak in commodities here. If I take a look at a different index, I think we've got the Reuters Jefferies index. This one, I think, will make a new record high. And the reason for that is because when we started hitting the lows in the pandemic, and this particular Thomson Reuters CRB index rallied up to 329, proportionally, it did a lot. It recovered most of the ground a lot higher than the preceding decline that began from the orthodox peak here. So if we do our Fibonacci measurements on this, we arrive at 682, and I think that will, obviously represent more oil rather than the Bloomberg Commodity Index. But overall, these commodity cycles are very important to understand, because if you start getting raptured into this idea that we're in a commodity super cycle, which lasts decades generally in that terminology, that's not going to be the case. At some stage, we're going to confront with new record highs, but they're going to be a bit of a bear trap. You need to be very aware that these things will run aground at some point, and then they will collapse afterwards. So you want to be well out of these commodities. And generally, of course, like always, the markets the sentiment will be most bullish at the extreme top. And that's something which a lot of investors will have to get attuned into, because it's natural for you to feel very, very bullish at the top of the market and very, very bearish and afraid at the bottom of the market. But in trading and investing in this way, especially these big volatile movements and these trends that develop, you've got to be really thinking more a bit like Warren Buffett. So at the financial crisis sell-off, what did he do? He said, well, there's blood on the streets, we're buying. We're gonna buy Goldman Sachs A shares, and we're going to start buying these investment banks because they're the ones that have been hardest hit. Their relative terms historically look cheap. We're not afraid of buying at these types of points of lows. Okay, you need some idea of when the lows are coming. So you've got to have some methodology to determine that. This is why I think Elliot Wave is such a great forward-looking vehicle and methodology to work with, because it's not only precision in terms of the pattern sequence. So we talk about that pattern as a qualitative process, but also we can measure these patterns within a high degree of certainty about how they should develop from a qualitative process, from a quantitative process using the Fibonacci sequence. And when we take a look at something like this over different time periods, and we can put it through different degrees of trend and the measurements, it really gets quite exciting, because when you get a convergence of Fibonacci ratios according to the pattern sequence, and they come together, you have a pretty good idea where it's going to. So I'm just extending this initial sequence up from the pandemic by a Fibonacci 61.8 golden ratio here. And that becomes wave B of a larger pattern, which we defer as an expanding flat pattern. And the B wave, the second sequence, which is this inflation pop, should ordinarily extend by this preceding decline by 23%, a Fibonacci 23%. And you can see they exactly overlay here. That's not a coincidence. So when we apply these things together, you have a pretty good idea of an excellent map or a route, a navigator route to see exactly how things will progress in the future. So we're not guessing here. This is very mathematical. It's very precise, and it gives us a very clear outlook about what to expect.
Well, I think probably the important takeaways from this is, as you say, this isn't something that is going to last several decades, the way that you have this laid out. And this is also an exponential chart. Am I correct?
Yes. I mean, it's basically exponential in as much that it rises and then falls back down. So you get this parabolic curve.
Mm-hmm. But I'm saying just the way that we're looking at it, that price move could actually would look a lot more dramatic on a linear chart, right?
Yeah, of course it would. Yes, of course. Yeah, this is logarithmic.
Mm-hmm. Right.
I think these measurements, if I actually put this into linear scale rather than log, you wouldn't certainly get the same coalescence in the Fibonacci measurements, and it would look very different. You're going to get a different scaling here. I mean, this advance, if it does go to where we think it should, which is all the way up here to this level at 682. That movement's going to dwarf this one.
Yeah, that's just the only point I wanted to make is just for those looking at that chart. It's actually a lot more of a dramatic looking move if you're not used to looking at that chart.
Log scale charts. Yeah, and that's a good point. Yeah, it would. Yeah, I mean that in itself I mean, okay, if you say, well, a super cycle commodity bull market is depicted by a percentage move, for example. But I think, you've got to think about commodity super cycles over periods of time, and the vast amounts of time that's unfolded rather than just movements. I mean, we talk about secular bull trends in stock markets, don't we? And I think that to a large extent, people think of a secular bull market lasting, a decade or so. We go back to the financial crisis lows for that. And I think that's good. But really, if you want to take a look at something like the stock market as a secular bull trend, secular, meaning time inference to that. But if we go back into a very, very long-term charts, I'm going to take a look at this is the Dow Jones with the foundation's long-term averages going back to the 1600s here. I mean, this entire movement up, is a long-term secular bull. It's not a secular bull trend. It's basically a super cycle. Mm-hmm. We're going back to, here's the Great Depression lows, but you can see now we're going back to lows that predate that, back to sort of 1842, back to 1782. And you can see, where these big long-term 94-year cycles, so they're sort of generational cycles, really. One generation. I'd like to think we can all live to 94. That would be good. But in terms of a lifespan, that's about one lifespan, isn't it? If you're lucky. So yeah, we got to separate those things out. Most of the stock markets are really in those secular bull uptrends. I mean, if you take a look at the movement up from the say the stock market, for example, the S&P 500 from the financial crisis lows, you're going to get let's have a look here, something like this going on. So here's the financial crisis lows. And this is still actually unfolding, unlike the commodity markets, which have got their orthodox secular bull uptrends or their super cycle uptrends finishing in 2008, pre-financial crisis. This is still running up in its major uptrend. Its long-term uptrend is still in play. And we've got a few rather sort of volatile expectations for this coming year. I mean, I'm still thinking that we're going to get a very strong decline this year in stock markets. Some of them could be as much as 30 to 40% down. I think we need that because when we take a look at, say, the example of the S&P 500, and we go and look at, here's a weekly chart now from the pandemic low. One of the key signatures of the post-pandemic advance is the fact that when we started to lift higher, we've unfolded into three waves into this January 22 high. I've just extended the initial swing by Fibonacci 60-1/8 ratio. I've not quite measured it properly, but it's about right on this 4800 area. And that three price swing event means that we're in a diagonal. The diagonal means that we've got to have a deep second wave before we can go higher. So we've got a bit of a risk this year that we could start to collapse lower. I think there's an evident risk in that play. And that's also very evoked in the way that commodities are working. So if we go to oil and you take a look at the oil price, we need to see oil prices drop down to slightly below $50 before we head up again to new record highs. We've got to see oil prices down to, I think probably something like $48, $49, which is a pretty big call because we have been declining already since that March 22 high here at 130. But we need to go through this regression phase because the post-pandemic advance, we've got a neat and tidy 5-wave pattern. This one's a bit exaggerated because of that 650 low. If we take a look at, for example, something like Brent oil, it's less exaggerated. I think we've got, this is a monthly chart. Maybe go to, this weekly chart's good. You can see that it's less accentuated at that low, at the pandemic low, and you've got a rather neat and tidy 5-wave pattern. This needs to get down So WTI getting slightly below 50, Brent finishing around $54. So this year is going to be a bit of a down year, I think. And that's also, evoked right the way through the commodity complex. The only exception being things like gold and silver and platinum and palladium, things like that are very bullish, actually.
Peter, before we get there, can we just think about, what this commodity super cycle, what crude oil, these inputs, how that drives inflation, and if we've seen the top for inflation?
Well, I think the inflation measure, I think probably one of the best ways, we've got CPI, we can look at CPI measures, and we have got very long-term data on CPI, and we've got that going back to the Great Depression lows, but it's very difficult to see an overlay. I think the best expression of inflation is really coming through on the interest rate scale. And one of the things is that as I mentioned before, the interest rate, the preceding interest rate and inflation cycle was in the late 70s. So when Bretton Woods disbanded, Bretton Woods went, we basically opened the floodgates to printing money. And that's when we started to see, the more money you have in circulation, of course, the more that the value of goods has to rise. And this itself causes, constant price rises like that feeds through into inflation pressures. Well, interest rates bottomed at the pandemic. If we go and look at a long-term 10-year Treasury yield, probably have a look at that. You can see here's the old high in 1981. Here's the low, pandemic low, and we've done a huge recovery since then. But that's not going to be the end of inflation by any stretch. We'll go through a regression period, and we can argue whether that's begun in October and is moving down yields already, or whether or not, for example, we could have one more flip to the upside, which I think is a risk that we'll be assessing in the next couple of weeks or so. It's just because wage growth is on the rise at the moment, which is adding a little bit of a flip higher for inflation. And while I'm on the subject, I've got this one template which comes from Bank of America, courtesy of them. Thank you very much, guys. And this is a really interesting chart because it's coming from their fund manager survey, and they say, well, 62% of the fund managers expect lower yields during the next 12 months. And that's quite a big statement. We know that there's been a lot of pricing in of rate cuts from the Fed since the last Fed meeting in December. But this is quite an amazing figure. And basically, this is a very contrarian indicator that actually rates won't decline as the fund managers expect. Because if you go back to this, you can see that we're
the highest ever, right?
Yeah, and this is the highest ever since their data began. And you can see that we're like a standard deviation over and above where we would normally peak. If you go back to around this period, which is at the bottom of the towards the end of the financial crisis lows, you can see that then eventually this data set starts to dwindle. And funny enough, if you go back to November, December 08, the 10-year Treasury yield actually rallied from 2% to 4%. It actually went up. So this is a bit of a contrarian warning sign that if you've got everybody crowding one side of the expectation, as always, we start looking at these extremes from a contrarian point of view, the opposite normally translates itself through. So rather than seeing lower interest rates this year over the next 12 months, as the survey suggests, the dominating theory, it sounds as if that we're going to see higher interest rates over the next 12 months period. So that's why I think I think we'll be able to determine whether that's the case in the next couple of weeks or more, because we've got a little bit of a rally coming through in the 10-year Treasury yields at the moment, and there's some resistance at 4.3% for those that are listening. And if it hits that number and turns down, then I think we're okay. Yields will keep dropping. But if they start to stretch their legs above 4.3%, then I think we could be looking at something like 569 later this year, which will be a very, very harsh outcome. Not because the market's so engineered itself into expecting, a continuous stream of rate cuts. Mm-hmm. And that will be quite devastating for commodities. It might even be the trigger point for the stock markets to drop, this 30-40% period as well. Mm-hmm. So, interest rates are very sensitive, but overall, this is not the end of the inflation period, because, we've had 35 years plus downwards, and interest rates are a good mechanism to understand where inflation is going in the future. So even though there will be a regression point for a year or more, we're going to see another big pickup as we move towards the end of the decade. There's going to be another big surge of interest rate rises, and that's going to mean inflation rises too. So this is not the end of the inflation period. This is not some pop. The other thing is, for those tuning in with a little bit of knowledge on Elliot Wave, if we have 5 waves up from the pandemic low to these current levels that we're seeing at the moment, which is evident in the shorter term charts, that means that you're guaranteed, after a correction, another 5 wave advance afterwards of equal amplitude or thereabouts. So yes, we're definitely going to see a lot more in the future, but that's probably 2 years hence, that begins that next phase. In between that, we've got this year where there's a tendency for yields to remain higher for longer and dropping down perhaps later, and a bit into maybe 2025. But after that, when we get to the end of 25 and into 26, 27, then yields could start to turn up again, and that's where the next inflation comes through. So we're not in any scale of event. We've got to look at this from a very, very long-term perspective in order to gauge what inflation is going to be doing down the road.
Mm-hmm. Peter, when we think about, what rates are going to do, how much of that can we break apart from the part that the Fed has control over and the other piece that the market actually has control over?
Well, I mean, ultimately, I used to be an advert believer that the Fed and other organizations, which like OPEC, you could consider a cartel, they try and influence price, but they can't really circumnavigate the rhythms that are unfolding. They can maybe amplify them, but they can't really change the directions of them. I think in this particular case, with the 35-year cycle in the interest rates, definitely the Fed have influenced the longevity of that cycle. And that's why you've got such an exponential rise here. It's not sort of like a rise which has taken a decade and gone like something like that, mm-hmm. and a flat line to get up here. It's gone pretty vertical, pretty exponential. And the reason for that is because if you're pressing down hard on a spring, which is basically what the Fed have done with interest rates, as soon as you let go, as soon as the dynamics change, and something like the pandemic has caused inflation pressures, we know all about the blockages of the flow of goods and services and so on, that disrupted the normal flow, then suddenly that spring's going to go vertical. And that's generally what happens in any situation where you're manipulating. Another opposite look at that manipulation was, and one which I always think about very much, I suppose, is the last time we saw really big commodity prices being influenced and manipulated was gold and silver during Bunker Hunt's period. The Hunt brothers were active in the late 70s. They saw inflation picking up after Bretton Woods. They got the Hunt brothers were big oil. They ran a big oil company in the States. They were the latter day billionaires, and they saw that inflation was going to eat away at their money. So they decided to buy first gold, but then the central banks had vast hoards of gold, so you can't really control that. So they got together with the royal family in Saudi Arabia, and they decided to buy silver. And of course, that sent silver from $1.50 up to $50 in no time, in just several years. So we'd never seen anything like that before, anything in history, not to that extent. And that was a great manipulation. But of course, it ended in tears because eventually, in order to control silver, they not only had to buy several mines, but they had to buy the futures market. And of course, the deposits to hold a futures contract were going up and up and up. Henry Jarecki was on the opposite side of them. He was the chairman of Mercator Goldsmith at the time, which was the US arm of the bullion dealers. And he was a very outspoken critic of what the manipulators of the Hunt brothers were doing. And eventually, they raised the Hunt brothers were buying futures, and they raised the deposits on the COMEX exchange so much that eventually it broke their backs. They didn't have enough money to maintain the positions. And then, of course, it was a collapse. So whenever you get to these extreme manipulations and you get exponential rises, you often get exponential falls. And so you end up with the normal parabolic. But this is what's happened here. And that's why, ultimately, it all ends, and you get these abrupt sort of turnarounds, U-turns. Just like the pandemic, when the stock market was dropping down or oil was dropping down, you then get a V-shaped recovery to the upside. Mm-hmm. That's always going to be the case. But no, inflation's not dead here, and it's going to be something that we have to consider, sometime down the road. Mm-hmm. Again.
Peter, I'd like to wrap up just another, or let's say put a bow on another subject that you had here. We talked about some of the US indices. Is this not just a US focused crash? Does this affect Europe? Does this affect China? Does this affect more of the world as well?
Well, definitely, yes. I mean, we're not talking about a localized phenomena here. We're talking about a global sort of meltdown. Mm-hmm. I mean, one of the things which is very interesting is that, and then we can take a look at maybe Europe, for example. So the S&P 500, just to remind everybody, we'll just have a quick glancing look, and then I'll switch to Europe so you can compare. They're very different things. The uptrend in the S&P is this secular bull uptrend defined by 5-wave sequence. So we're going up to 7,000 for the S&P. But so we're going way above the old financial crisis highs here, way above, and we have done. And we've got still more to do. Again, this is log scale. So, this is, it doesn't look as if there's much room to go, but that's a big movement, especially if we do get a sell-off this year. On the other hand, if we take a look at Europe, and we look at the Eurostoxx 50, we can see a very different thing going on. Here is the orthodox top of its long-term bull market. So this is a bit like the CRB index that we started with today. Got a very long-term uptrend finishing here. So this is actually the .com high. And this swing down was the beginning of a very long-term correction, 3 price swings. Again, we saw 3 price swings down for oil prices. They bottomed in 2020 at the pandemic low. This one bottomed a lot earlier at the financial crisis sell-off low, but still 3 price swings all the same. The recovery point is a very overlapping pattern. It's not like the S&P, which has almost like a vertical ascent in its bull market, its composition of 5 waves, which is defining that sort of expensive uptrend. This one is a rather laborious effort. It's really struggling to keep up with the S&P, and it's not really doing a good job. And so when we get these pockets of corrections down here and here, the pandemic, and then recovery, and last year's or 2022's decline here, you get these rather deep sort of corrections coming in. And we call this, actually this pattern, entire pattern is a double zigzag. And it's definitely part of a larger expanding flat pattern. So this looks very similar to the way oil is moving up. It's going to make new record highs 2 or 3 years down the road. but then it's going to be a bull trap and it's going to collapse afterwards. And so this has got a very distinct pattern difference. And it's great actually to do or to analyze the different patterns between, say, the S&P and the Eurostoxx 50, as such as it is with something like the MSCI Emerging Market Index or something from China like the Shanghai Composite Index, the A-shares. Mm-hmm. They are very, very different creatures, but they have a distinct pattern. But these patterns are giving us a directional overlay in the same degree. So, in other words, they're synchronized up and down, but the amplitudes and the performances are slightly different, so they create different patterns. But generally, they're moving up and down in synchronous form. But because of the amplitudes, they're unfolding into slightly different patterns. But the important point is then that, if you're going to get, for example, the S&P dropping down in a deeper correction this year, you should also see it in Europe, and you should also see it in a lot of the Asian markets, maybe some of the BRIC countries as well, things like Brazil, Russia, India, which has been a very big, strong market in the last 12 months. They should all come down very, very sharply. And that's consistent with them. And then they'll recover again. But the pattern's different. But the synchronization is still very much there. It creates a lot of very tight integrity if that's definitely coming through like that. Yeah. Yeah.
Peter, when we think about how interest rates affect the dollar, are you expecting more strength for the dollar this year? As really, you can explain it a couple different ways. Let's say as a flight to safety out of the markets that are tumbling like this.
Well, normally you would say, right, okay, we're going to see a flight to safety. Surely that means that if we got a 30 to 40% drop in equities, surely we're going to get the dollar strengthening. But we're not, unfortunately. Certainly not. That's not our expectation. And that is quite a significant sort of event, because if we take a look at the dollar index over the last couple of years, we've seen a very strong development up into this high, which was basically September 22. And that ended a very long-term uptrend. And we've since, certainly through the back end of 22 into early 23, we saw this five-wave development down and a three-wave correction moving up into the October high, September high last year, October. And just recently, we've been dropping down from October's high into the end December low here at 162. We're seeing a bit of a counter trend swing up at the moment, but this is very bearish for the dollar. Mm-hmm. I foresee that this year we're going to see a bit of a short-term rally. This will last only a month or more, and then the dollar's going to collapse, I think. So we're going to be looking at this decline in the dollar index for this year. We're going to get down to something like returning back to these sort of levels around 89 for this year, which is really bearish. So the question is, why would the dollar decline like that? Especially if we're talking about sort of asset prices dropping as well. Wouldn't we get a flight to safety? It does make perfect sense that you'd expect so, but I'm just not seeing it. So we've got to look at some other sort of fundamental trigger. I don't have a crystal ball, mm-hmm. which would give us an idea, but we can have an educated guess. I mean, we do know that there's been a huge drive away from what we call de-dollarization, mainly from the BRIC countries, because I think since post-COVID and because of all this efforts from Western governments to control the dollar-denominated system, particularly with sanctions against Russia, for example, against Russia because of their invasion of Ukraine. These countries like Russia, even Saudi Arabia, have a new trade agreement with India to supply oil to India and swap local currency with them. We can see that in China as well. And it seems like that BRIC is a breakaway group to the Western stronghold on the dollar. And I think, that may start to leak as we progress this year, and that might become a bit more of a narrative and weaken the dollar accordingly. But it's going to be interesting to see that. We can see corresponding currencies like the euro obviously driving a lot higher, same as sterling, Canadian dollar also, Aussie dollar, all the commodity currencies start to accelerate higher. But it's not currency strength, it's just purely dollar weakness. We see it right across the G10 dollar pairings. And so really we've got to be very alert to a change in narrative and expectations on this. One of the things which, we've seen oil prices dropping down since March 22, but the dollar hasn't really been in an uptrend during that time. So there's a bit of discorrelation going on between the normal idea of what the dollar does and what that effect has in commodities. The only thing that I tend to look at day to day, and maybe a little bit further ahead, is how the dollar weakness might affect gold and silver. I think that those precious metals will be the main beneficiaries of dollar weakness.
Mm-hmm.
And
just as a comparison, right?
Yeah, I think I've got quite a few institutional clients and family offices who are long dollars, want to be long dollars, and I've told them also that, look, we've got very big downside risk in the dollar for the next couple of years, and particularly for this year. If they're reluctant to actually swap out of that dollar-based position for their investments, and of course most investments do require you to trade in dollars these days, so you've got no way of circumnavigating that. You can hedge up to a point, but those hedges can expire and leave you still stranded. The best way to augment or hedge that is basically buy precious metals. Mm-hmm. So I'm not a big gold bug historically. I just look at gold and silver moving up and down in the same as anything else I look at. Mm-hmm. It's just about wave development and understanding how it develops and the amplitudes. So I don't get over emotional about gold like the gold bugs do, but I still think that gold could go up to 2,800, no doubt. Silver can do $60-$65, and I think platinum and palladium in my analysis is probably going to outperform those two. Mm-hmm. But I think that that's a good way to hedge. If you're not too geared up into futures markets and things, just buying precious metals is probably a good hedge against dollarization. Yeah.
Mm-hmm. It's interesting. I spoke with a guest yesterday that offered another possible explanation, I think, for, a further dollar decline. And that's just loss of confidence, especially considering that around that same time, we're going to get the election in the US. So it's interesting to kind of put those two pieces together and understand that it could be a loss of confidence abroad that's driving less demand for the dollar as well because of, let's say, the outcome or how the election is handled too.
Yeah, it could be something from the election. I mean, again, I'm not a great one for politics, and a lot of people look at the presidential cycles and things like that. But I ultimately see I think the dollar, of course, loss of confidence can come through with that, and to a certain extent, this year you've seen loss of confidence. Well, certainly since October time, suddenly the dollar suddenly dropped away. To some extent, that's been indicative of the way that yields have pulled a bit lower. But no, I don't think that the dollar's got a huge upside this year. I think we're going to be correcting for the next month to the upside, and maybe 2 months if you're lucky. Mm-hmm. And then the time scale runs out. I think we're going to get some pretty big declines, and maybe it will be a loss of confidence, and maybe people will be thinking forward to the election. But I'm more thinking in terms of really these trade routes and coming out of this way in which we have to transact dollars. Don't forget, here in Europe, if we want to transact in dollars through a payment system, we have to go through the banks. It has to be transferred into a middle currency first, and then goes into dollars afterwards. And there's always this throughfare of dollar transaction, which we do with pretty much everything. And I think that there's a very, very big push away from that at the moment. There's lots of different ways of alternative payment systems, and maybe something which we haven't talked about today, but maybe cryptocurrencies are going to be, driving forward in the longer term, not necessarily over the next few months, because I think they're a bit overbought. But ultimately, things like Bitcoin will be still an attractive investment, alternative investment. Yeah.
So, Peter, let's go back to talking about how this comparative mechanism of the dollar will, let's say, over a couple different timelines, affect the gold and silver and really the precious metal prices in general, because you're looking at platinum and palladium, obviously, as part of the precious metals complex and the opportunity there as well.
Well, I think the gold price is, I mean, we can look at this from different ways, but I think that ultimately, let's have a look at gold here. This is back here. This is the last time that gold hit bottom. This is cycle wave 4 within its uptrend, long-term uptrend, and we're moving up in a development of 5 waves, and we've got a target here about 2,800. People are talking about 5,000 for gold, or I mean, some even more than that. But I think realistically, it's not really likely. I don't think, even with the dollar moving down so much, certainly from the proportions here, I think anything over 2,800 would be an excessive move for gold. We've done a lot of ratio relationships, and we're working on some now, because actually we're in the middle of doing the analysis for our annual commodity report, which we hope to be releasing in a couple of weeks' time. So if anybody wants information on that, let me know, and we'll tell you how to get access to that report. But we're going to show some very long-term charts on gold, and the way it works with some of the ratios with platinum and palladium, and even silver. The gold-silver ratio suggests that silver is going to be a big outperformer than gold. And if we take a look at that ratio, this is the gold-silver ratio. We've had a huge devaluation of silver into the pandemic. It was 126.26. That means it took 126 ounces of silver to buy 1 ounce of gold. So we've got gold divided by silver for this ratio. But since then, we've seen silver outperform gold. So we came down in 5 price swings here. We've had 3 price swings up, and the trend is downwards for the next couple of years. So basically, with the ratio narrowing again, that means that silver is going to be a big outperformer than gold. Now, we've got targets on silver at about $60, $65. I mean, if gold gets to 2,800, let's say we get down to 50 as an interim target during that phase, that means silver will go to $56. That's about right, basis our independent measurements of the pattern. I guess that says silver gets to $56 minimum. I don't know whether it will reach 40.42, which is the ultimate downside target in that time span. It's one thing I'm not sure about. But if we did go to 40, that would mean even higher levels for silver, of course. So I think on a conservative basis, silver, you should be planning $55, $60 over the long term. And I think platinum looks really great. I really like platinum. And I'm actually building very big positions at the moment for some of our institutional clients. And platinum, let's have a quick look at that one. I think we're going to look at a very similar function to crude oil, where the very long-term uptrend finished here at 2,300. So that's, again, the financial crisis highs. You had 3 waves down, just like crude oil. into the March pandemic low of 2020, and we're going to have an inflation pop cycle, which is a mini cycle lasting a decade or so. We'll get up to about 3,100. But that means, again, we're going to see big outperformance in platinum over silver and over gold. So these are great ways to hedge a dollar, de-dollarization. If the dollar is going to be trending down for the next several years, this is a very good way to circumnavigate that without having to put on elaborate, cost-effective hedging at the banks or with your broker, where you've got to roll over and stuff like that.
Mm-hmm. So it's just a matter of understanding, again, the timelines, shorter time, or let's say nearer to us, you're expecting some pullbacks, but ultimately, of course, a lot of the metals as a comparison just do much better than the underlying currencies that they're priced against. Well, that's right. I mean, obviously, this is a great effective way of not being leveraged, really, to protect yourself from dollar declines. Mm-hmm. And precious metals have bottomed already. So if you're not leveraged, it's a great way to maintain your long positioning there, and you don't need to worry about timing too much. Because these will go hand in hand. These movements up will go hand in hand with dollar declines, and I think that will serve its purpose. It's much better to do it this way. And of course, we're talking about a dollar devaluation over the very long term of something like 50%, which is a lot. But if you consider this gain, if we go from 31.12. Where are we today? 942. You're talking about us. Yeah, that's well, actually, that's a 60. No, that can't be right. Let me do it again. 31.12, 942. Yeah, it's a gain of 230%. So you're more than taking advantage of dollar declines. If you've got to hold dollars and you see a 50% downswing, you're going to make 230% on the other side of it. Mm-hmm. So, in other words, three times your value. Mm-hmm. Peter, as part of the precious metals complex, or let's say as a derivative of the precious metals, how do you see the miners doing in that environment where the metals are appreciating greatly over the next couple of years?
Well, the gold miners outperformed to the upside when we bottomed in late 2015, 2016. Mm-hmm. And, I think gold went up something like 20-30%. And we saw, well over 100% up in the gold miners. So they should outperform generally. They've done a lot already, whereas in retrospect, gold bullion hasn't, it's been obviously locked in a 2-year sideways trend prior to now. But if we take a look at something like Newmont Mining as an example of its larger degree uptrend, we're going to see some very big, strong multiples here. So we're currently today around 39.40, let's say 40, and we're going up to 250 as a target. So the miners again should really outperform during that phase. Mm-hmm. So I think the miners are good because ultimately, you're going to be benefiting from the fact that you're getting obviously much bigger leverage than the underlying bullion. The only thing is that again you're trading paper currency because you're basically you've got some, to a certain extent, you've got some exposure of counterparty risk, and I don't say that aimlessly, because there's always counterparty risk with a broker. Even the big ones can go financially insolvent. The nice thing about buying precious metals is that you can basically, it's a store of value. So you can buy it physically. The average person can buy that physically and hold it without having to do rollovers or whatever. But nevertheless, I think if you're prepared to take that risk, counterparty risk, it's no problem for you to be able to buy into the miners themselves. I think there's, the precious metal miners look pretty good. Even things like platinum and palladium, you can buy the ETFs. If you're not worried about counterparty risk, then you can buy the ETFs. I think palladium, there's one which is PALL, which is a good vehicle, and platinum too. So I think platinum is PLA if I remember correctly. So check those out, because they can be good plays on the underlying. But I think the miners themselves look pretty good generally. I like them a lot. Yeah.
Peter, the only other thing I wanted to go over with you is, let's say, the base metals complex. If we're expecting a kind of a global slowdown here, how does this affect the base metals, iron and copper?
Well, I actually looked at iron ore today, and it looks pretty strong. I mean, we've come from a low point of around $80, and it's run up really quite nicely now. So iron ore looks as if it's trending up. But when I look at the base metals, there's not a lot to do on the downside, because they've been trending down for the last 2 years, actually. If you go back to sort of May 21, early 22, they've been dropping down like copper. And I've still got a bearish forecast for copper this year. So we can use copper as a benchmark. Let's have a look at the weekly chart here. I've got a target down to about, this is London Metal Exchange. So the reason I use that and not COMEX is because sometimes you can get rollover gaps, which can be rather misleading when you terms of the measurements of the pattern sequences. So the London Metal Exchange has this 3-month rolling contract, which doesn't have any expiry. And the targets are 58.70. If you want to put that into COMEX terms, 58.70 divided by 2204.62. So that would come out to about 266 as a downside target. So if you're familiar with COMEX, the numbers, that will probably ring true. But I still believe that we can get that one sell-off. This particular pattern is what we call an ending diagonal. And it's a 5-wave process, which is necessary into new record highs. This is a target up at almost $14,000 a ton. But this year, we need this sell-off before finishing the 4th wave. So that this particular megaphone type of expanding diagonal pattern has fulfilled its criteria of the widening boundary lines that dictate this pattern. So we do need this sell-off this year. So I think copper looks vulnerable in the shorter term, so for the next several months. But afterwards, again, record highs. Like everything else, oil comes down to $50, sub 50. Copper comes down to here. The CRB comes down, and these industrial metals really sort of pull lower as we go into a downturn, a dip for this year, and then after that we start going ballistic to the upside. So catch those trends certainly when they begin, but try and deleverage it a little bit this year,
which is also inflationary.
Yes, when the markets have bottomed and they start to turn back higher again, that will be definitely putting the inflation score back into the equation again. So that's really where I think inflation is not dead, because of the long-term cycles. Really, you've got to understand that we've been in a deflation cycle since 1981 to 2020, and now we're in an inflation cycle. It's just getting our heads around that and getting accustomed to that idea and thinking. But this is where some of the central banks should have been a little bit more prescient of action, because what they did really was they failed to recognize these long-term cycles. And it's amazing, really, because Edward Dewey he he was an economist going back to the President Hoover period. And he was, I think, if I'm not mistaken, he was actually hired by Hoover to find out why the Great Depression, why the stock market collapsed. And he was an economist, and he got involved in cycles, and eventually said, reported his report was basically, there's a long-term cycle that's unfolding there, and that's why the market collapsed. Mm-hmm. And then, of course, later he got so interested in the subject that he created the foundation for the study of cycles. And started looking at cycles in all sorts of different things, not just stock markets, but lots of different things, human behavior, natural phenomena as well, and recognized there was a cycle controlling all of these things. And really, so you don't need to be some geeky sort of technical analyst. You can. Even an economist should be understanding what cycles are all about, mm-hmm. Just as he did, and appreciate them. The central banks should have really been a little bit more sort of aware of these cycles than they could have themselves known that at some stage, we would have seen an inflation liftoff, and that meant probably controlling interest rates a lot better than they did. They were far too late, and now they're probably sort of overreaching a little bit towards the end of the cycle in this particular phase. Yeah.
Excellent, Peter. Well, I think we've covered how all of these different things actually fit together, and then your outlooks for the short, medium, and kind of long term here. Is there anything else you'd like to share with us before we wrap up here today, Peter?
Well, I think if it's okay with you, I'd just like to say that if anybody watching or listening would like to get some information about some of the other work that we do, mm-hmm. We're in the middle of publishing our annual reports at the moment. It forms a trilogy series, which starts off with stock indices, and then we move on to commodities, which we're doing at the moment, and mm-hmm. and then we'll be publishing currencies and interest rates in early February. The stock indices report is out at the moment. This is what it looks like, and it accompanies, there's 130 pages in here. So it's a very detailed look at a lot of the forecasts that we've seen today in stock markets. And, we go through basically US. We've also got a very interesting section that a lot of people tuning in might want to be an update from. We've got a technology and the FANGs Plus indexes and the MAG 7 stocks. Mm-hmm. Which might be of interest to everybody. So we're looking at through those. And of course, if you click here, it'll open up another window, which is a 2 hour 30 video of me talking through all of these. So this is part of our trilogy series. You can buy these independently, these reports. I think that one you can get an idea from, let's have a look at our website. If you go to wavetrack.com, you can actually go to the top right here, and you can see that it says Stock Indices Video Part 1, should be. 1 of 3, yeah. Mm-hmm. And there's information about how to subscribe to that. And I think right at the bottom, there's some details. And I think you can either buy the trilogy package together, or you can buy a one-off for those. So that's really interesting. I mean, obviously, if anybody's interested in those, I very much encourage that. And the other thing is that we do publish a rather sort of a global market report twice a week. And this is called the Elliot Wave Compass Report. And if we go to subscriptions here, the Elliot Wave Compass Report is $39 a month. You get 2 reports a week and a login to view them online as well. So these are a couple of ways in which you can keep up to date with us. Yeah.
Perfect. And of course, you guys are available on Twitter as well at Elliot Wave _WTI, right?
That's right. Yeah, I think our Twitter feed is at Elliot Wave _WTI. Yeah, absolutely correct. Yeah, that's right, Tom. Yeah. So please do. We're often posting when these reports are available on here, and a few other tidbits. So keep in touch with us, and we'd very much like to for you to join us and take us through this next journey for this year.
Absolutely. Peter, thanks so much for your time today. Really appreciate getting to get your perspective again here.
No, it's great, Tom. Like always, really enjoyed our discussion, and Happy New Year to you.
Happy New Year. Thanks. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.